All right, let's dive into the Q3 2025 earnings for Eckers Commercial Realty. That's ticker ACR. Now, at first glance, the numbers looked a little, well, mixed. But boy, did the market's reaction tell a whole different story, a much more interesting one for sure.
So get this, on the day they announced their earnings, the stock just rocketed up almost 10%. But here's the kicker. It wasn't because they crushed every single metric. Not at all. It turns out the market was looking at something else entirely, something much deeper.
And that really sets the stage for the big puzzle in this quarter's report. You've got these headline numbers telling two totally different stories, which left investors asking one central question.
Okay, so on one side of the coin, you have their GAAP earnings per share. It came in at a super solid $1.34. I mean, that's a clear beat, right? Looked absolutely fantastic on paper.
But then you flip that coin over and whoops, top-line revenue actually missed what the analysts were forecasting by about 5.4%. Now, usually when you see that combo, earnings are up, but revenue is down. It can be a bit of a red flag. It kind of makes you wonder if the profit came from something like one-time gains instead of real solid business growth.
So, that's the big question, right? If revenue was a miss, why on earth was the market popping champagne corks? What exactly were investors so excited about?
And here's the answer. It's because the market wasn't even looking at revenue. Nope. They were focused on a totally different number, book value per share. And get this, it jumped from just under $28 all the way up to almost $30 in just one quarter. And that right there tells you everything you need to know about where this management team's head is at.
So, how'd they pull that off? Was it just a lucky break? No way. This was all part of a very deliberate, very smart strategy. It's all about something called capital recycling, basically unlocking hidden value that was just sitting there on their balance sheet.
Okay, so management ran this really clever three-step play. First up, they sold off a real estate asset and pocketed a cool $13.1 million gain. Step two, and this is the really smart part, they used that gain to unlock the value of their deferred tax assets. That's a huge win for them. And finally, step three, they took all that fresh cash and started putting it to work, funding new commercial real estate loans.
And hey, you don't have to take my word for it. Management basically spelled it out for everyone on the earnings call. They said this move was, and I'm quoting here, a significant part of our strategic plan to maximize shareholder value. So yeah, this was no accident. This was the game plan from the get-go. And this strategy looks even smarter when you see where they're aiming that new capital. Their loan portfolio, it's 75% weighted towards multifamily properties. And in a market like this one, that is an incredibly defensive, super resilient place to be. A very smart move. And as if that wasn't enough, the board of directors threw in another huge vote of confidence. They reauthorized another $7.5 million for their share buyback program. I mean, that's basically them shouting from the rooftops that they think their own stock is a bargain right now. So with all these moving parts, how did the market actually react? What was the final verdict? Here's the bottom line. The market just completely ignored the revenue miss. Didn't care. Instead, investors gave them a huge thumbs up for their smart capital strategy, for beefing up their balance sheet, and of course for that massive jump in book value.
And wow, just look at the results. Over the last month, ACR gave investors a total return of over 7%. That didn't just beat the S&P 500, it crushed it. And its direct competitors in the mortgage REIT space, well, the chart says it all. They got left in the dust. That, my friends, is what pure outperformance looks like.
Management also made a point to talk about a number called earnings available for distribution, or EAD. Think of it this way. For a company like this, it's a really important metric that shows their real cash flow, the money they actually have to pay out dividends. At $1.01 per share, it's a really solid foundation that they're looking to build on.
Okay, so that's the story of this quarter. But what about the next one? What should you be watching for on the next earnings call? Well, here's our take. We're keeping our eyes on 4 key things. Number 1, how fast are they making new loans? Are they putting that cash to work effectively? Number 2, that share buyback program. Are they actually going to use it, and how much? 3, when are they going to sell off their other assets? And finally, number 4, you always have to watch the bigger picture. What's the overall mood in the REIT market? So, if we're putting on our forecasting hats for Q4, here's what we see. We think that book value is going to keep creeping up, probably getting pretty close to that $30 mark management hinted at. And remember that small dip in the portfolio size? We expect that to flip back to positive growth. As for EAD, we're forecasting it to stay stable, maybe even tick up a little. So, when you put it all together, the brilliant capital recycling, that laser focus on book value, and the fact that they're just plain beating the market, our rating for ACRE's Commercial Realty is a confident outperform. We really believe the strategy they're running is creating real, tangible value for shareholders.
And just a quick reminder for everyone, this is not financial advice. We're breaking this down for informational purposes only. So please always do your own homework before making any investment decisions.